Hello, fellow Rebel Capitalists. Hope you're well. So we've got new inflation data out today. The PCE report from the Bureau of Economic Analysis, I believe. And spoiler alert, it's down. Less than expected. But I think what's even more important is what's happening month over month. And then we have to see the details and determine how is this going to impact what the Fed is doing. Because remember, the Fed says that they pay more attention to the PCE than they do the CPI. And when you're looking at them, their target rate, getting that down to 2% inflation, you got to focus on where the PCE is. This is very important. And then we're going to go into how markets are responding. The stock market, gold, Bitcoin, and of course, interest rates in the bond market, which, as you guys know, I think is the most important. So first and foremost, let's go over to CNBC. We're going to get a summary, and then we're going to go over to the Bureau of Economic Analysis website and go over some charts, some details. And another thing that I'll share with you before we get going is this is the lowest inflation rate based on this metric that we have seen going all the way back to the cerveza sickness. We tied it in September 2024. Now we're right back down, and that's a level that we hadn't seen since, I believe, February of 2021. But we're going to get into that in just a moment. First, let's go over to the CNBC webpage. And by the way, for you diehard Rebel Capitalist fans, I've got a very special surprise for you at the end of this video. Super, super cool. So if you're a fan of the Rebel Capitalist brand and the Rebel Capitalist channel, you're definitely going to want to stay tuned to the end of this video. All right, so let's shoot over to CNBC. We've got inflation rate spiked. Inflation rate slipped. A little bit different there to 2.1% in April, lower than expected. This is the Fed's preferred gauge. So key talking points, there's the PCE, personal consumption expenditures. Now, when we get into this article, you'll see it's not just about what's happening with the PCE. It's also what's happening with retail sales and consumption. And keep in mind, when we get into those numbers, they're not adjusted for inflation. So if you see a 0.1% month over month, that is not real, literally and figuratively, meaning that's not adjusted for inflation. So if we had any inflation this month, then that's going to be a negative number, or close to it, depending on the degree to which we had inflation. Okay, so let's see here. Key talking point, 0.1% for the month. And this is what I like to focus on, because at the 2.1% year over year, you get a lot of base effects. So let's just assume the 12 months back, we had a 0.9 or something like that. Well, that falls off. And then this month, it's just a 0.5. Well, it's going to dramatically drop the PCE year over year, but that doesn't really tell us anything about what's happening more recently to prices. That's why you also have to look at the month over month. Very important. And just to reiterate, the month over month is 0.1% increase. Okay, now the core, this is minus the volatile food and energy. They always have to say the volatile for some reason. This comes in at 0.1 as well, and so the year over year is 2.5. And remember, the Fed's target is 2%. So, I mean, you're getting pretty darn close. But this also really shows how ridiculous that target number is. So you're telling me, Federal Reserve, if we're at 2.1%, well, oh my gosh, you've got to be hawkish. We have to be hawkish because, we're really risking inflation to the upside, or we're really risking letting that inflation genie get out of the bottle. We're really risking, quote unquote, stagflation. But if the CP or the PCE is 0.9, so 20 basis points lower, then all of a sudden, holy cow, we got to worry about deflation. We got to cut ASAP. We got to do QE, or else we're going to go into a deflationary death spiral. That's how ridiculous this number is. Just this totally arbitrary, by the way, 2% number. And I think it also reveals how ridiculous the Federal Reserve is to begin with, and how they're really not, Snyder always says, I totally agree with him, they're really not a central bank. They're just kind of it's all smoke and mirrors. Or I think what he says is the central bank isn't central. And once you really start to get into the monetary system, you see that it's just so true. And the only thing that they have is just these psyops where they try to make you believe that they somehow control interest rates, as opposed to interest rates just being a reflection of what's actually happening in the real economy. Consumer spending, though, slowed sharply, posting just a 0.2% increase. I think I said it was 0.1 earlier, while the savings rate surged to 4.9. So this is really interesting. Number one, remember that 0.2 doesn't adjust for inflation. Number two, if the inflation rate went up to the savings rate went up to 4.9%, well, there's two reasons why that likely happened. Number one, the American consumer is just making so much money because the labor market is so incredible that they're just making way more money than they can even spend. That's option number one. And I would agree with most of you watching this video right now. You're probably saying to yourself, okay, that's a pretty low probability. But option number two is they are in the trenches every day, and they really have their finger, the American consumer, have their finger on the pulse of what's really happening in the labor market. And they can sense that the labor market is softening and things are getting a little bit worse. And therefore, they're just trying to prepare for a rainy day. So those are your two options. Obviously, I would lean more toward the latter, but you can come to your own conclusion. So like we said there, inflation barely budged in April, month over month. Year over year, it went down. As President Trump tariff implemented in early part of the month had yet to show up in the consumer prices. Excluding volatile food and energy, the core reading tends to get even greater focus from the Fed, showed 0.1 as well. And like we said earlier, that's 2.5% year over year. Now, the estimates were 0.1 and 2.6. So the year over year, that was slightly below estimates as well. Consumer spending, though, slowed. Like we said earlier, 0.2% increase in line with consensus, but slower than the 0.7 in March. So we're seeing a decline there. The more cautious consumer mood also was reflected in personal savings rate. And I would agree with CNBC here. I think this is definitely because the consumer is more cautious about the overall economy and the labor market, as opposed to they're just flushed with cash and they can't even spend it all. Trump has been pushing the Fed to lower the key interest rate. We talked about this in yesterday's video. And I've got to agree with Trump right here. I don't necessarily agree with his tactics, but he's right. I think the Fed has rates way too high. And, the ECB, all these other central banks, at least in the developed countries, are dropping rates. I mean, South Korea, I think, was a bank that dropped rates yesterday. And I think the Fed is, as usual, kind of behind the curve here. Now, the argument is that no, inflation is still sticky. It's still above the 2% target rate. And we have a strong labor market. We have all of this savings that's just pent up demand. And we also have the tariffs that could increase the prices of some goods. And once inflation expectations set in to the overall economy, then that's going to lead to higher and higher and higher and higher prices, like this spiral that they always talk about. And I get the argument, but I just don't agree with it, because I think in order to have that accelerated inflation, which you would expect to see in a stagflationary environment, you have to have nominal wages go up. It's simple. You've got to have wages going up. And I think, they might be going up, but they're not going up at the rate that consumer goods and services have gone up over the past 2 or 3 years. And so you've got on net a negative aggregate demand. And so even if you do have the prices going up at Walmart because of XYZ tariff on China, well, that's fine. The people have to pay the higher prices, and you will see that component of the basket of goods go up. But that means they're just taking spending away from something else that doesn't have tariffs. So the example I always use is, okay, well, let's just say that you're buying this much stuff at Walmart and this many airline tickets. All right. Well, let's say that the price of the stuff at Walmart goes up here. Your paycheck doesn't go up by that much. So the amount of airline tickets that you're able to buy goes down. So it is true that these prices are going up, but these prices are likely going down. So when you look at the basket of goods, you don't have much of an increase. And I think that's pretty much what we're seeing here. The other thing that I think we'll probably discuss in this video is the fact the the trade deficit went down substantially. Now, why is that important? Because the trade deficit was a drag on GDP. That's one of the main reasons we had a negative number. And so a lot of the bulls or a lot of the people that are kind of in the inflation camp or the stagflation camp, they say, all right, once we get past this front loading of these purchases, which increase the trade deficit, by the way, once we get past that, then the economy or the GDP number is going to explode higher because you're not going to have that drag on the overall GDP formula due to the trade deficit, which is usually, let's just say 100 billion, going up to 180 billion or whatever it was. But this, I think, is this optimism, if you will, about the GDP, I think is misplaced because it totally ignores the rest of the components that went into the equation that got the negative 0.2 or 0.3% to begin with. More on that in just a moment here. So Trump faces off with Powell today. They had a meeting, and I tweeted about this. I won't bring it up, but basically the tweet was talking, I think it was from Market Watch or something like that. And they were discussing how, Trump wants to bring rates down to boost the economy, and Powell wants to keep rates higher because that's going to put a stranglehold on the last bits of inflation. And my comment here, which is something I really try to drive home constantly, it's that the interest rates really don't control the economy to the extent that people think they do, or the Fed would lead you to believe, or to the extent that Trump thinks they impact the economy. So he always talks about how the ECB has such a great advantage because they have lower interest rates than we do. But you got to be careful what you wish for, because the reason they have lower interest rates is because their economy sucks. Their economy is worse than the United States. That's why they have lower interest rates. So my point is that whenever you're thinking about interest rates, don't really think about interest rates in terms of controlling the economy, which is where most people start. Think about interest rates as just simply a price signal. And what those signals are telling you is they're telling you about the strength or lack thereof of the real economy. They're simply a reflection of what's happening in the economy and what the expectations are for the economy. They aren't necessarily a tool just to bludgeon the economy over the head and force it into submission to do whatever it is that you want it to do. So as an example, I would strongly encourage you to go back in time and see when the Fed dropped rates where the economy was actually, quote unquote, stimulated. Show me a time when the Fed dropped rates and that led to economic growth. You can point to one time. That was 1995. And we didn't have all these inverted curves, and we didn't have negative swap spreads. We didn't have a lot of these other components. So, even with that, you've got 90% of the time when the Fed drops rates, it doesn't do anything. It doesn't prevent the stuff from hitting the fan. The stuff still hits the fan. Why? Because those lower interest rates are a reflection of the economy. They don't control the economy. Getting back to this, economists worry tariffs could spark another round of inflation, though historical records show their impact is often minimal. Right, with the exact same things that we discuss on this channel. And we talked about that yesterday on the video, where even if they do lead to price increases on this component of the basket, let's say the Walmart component, it's a price adjustment. It's not, okay, the prices go up by 10% because of a 10% tariff. And then the next month, they go up by another 10% and another 10% and another, they don't keep accelerating. They just adjust higher. Now, is that going to impact the consumer negatively? Absolutely, it will. But over a long period of time, if you zoom out, it's not really going to show up in a huge acceleration in the CPI. It's more so going to show up in a decrease in economic output. Okay, now let's go over the Bureau of Economic Analysis. Let's look at some charts. And this first one, let's see, disposable personal income, outlays, and savings. Aha. Okay, so this orange is the outlay percentage change. So big drop there. That's what CNBC was referring to. But then we have that big increase in the savings rate. And by the way, we've seen this trend higher since pretty much the Q4 of 2024, which I think in of itself says a lot. Here are the changes. So you see the good side of the equation here was really dragging it down, and then the services side increased it substantially. This is what I was referring to earlier, how we haven't been at 2.1% since the middle part of 2024. But if you look back further, you would have to go back to 2021. I believe it was February of 2021. And here's kind of a summary of the overall numbers that we went over with that CNBC article. So now what I'd like to do is go to, and I forgot to pull this up. You'll have to bear with me. Let's go to last GDP report. And hopefully we can get a chart of the components of GDP. Let's keep our fingers crossed. Let's actually see if we can just go to an image. And I do not see it. Okay. So let's try something else here. We're going to go components of real GDP. Net exports, government spending, investment. So the one main thing I want to focus on, or two main things I want to focus on, inventory. Here we go. Let's just show me the darn. All right, Josh, you can see that, right?
Yes.
Okay. So guys, these are the inputs to GDP. And so what most people focus on, especially the people that are very bullish, are the net exports. In other words, the deficit. So if we have a $180 billion deficit, trade deficit, that's a subtraction from GDP. That's a subtraction from GDP, because what it's really trying to decipher is the amount of goods and services that were actually created here. So you've got to take all the aggregate total of everything that was purchased, and then you've got to subtract the deficit, because although that was purchased here, you can tell, broadly speaking, that wasn't actually produced here. But then these other components are very important as well. So we've got inventories. Now, this is something I want to highlight, because last month, what you saw is a huge drag on GDP, which is one of the main reasons we got down to negative 0.2 or negative 0.3. But you had a huge spike in inventories. So that huge spike in inventories increased GDP, all else being equal. And the huge spike in the deficit, the trade deficit, decreased GDP. So this next month, or this last print that we had today, now let me go over that real quick here so you guys are following kind of my line of thought. This is, and okay, this is U.S. trade deficit in goods plummets in April, pointing to stronger second quarter GDP. So you see what they're doing there. They're just assuming that the only reason we had a negative GDP last time was just due to this trade deficit. So if you strip that out, then hey, we're going to be at like 10% GDP. But I think that's not really understanding the nuance here, which is incredibly important. So the last number we had 162. And this time it goes down to 87. So you're basically going to have $80 billion that is not going to be subtracted from GDP. And okay, that's great. But most people just myopically focus on that and they forget everything else. So if we had inventories explode higher, which added to GDP last time, and that was because everyone was front running these tariffs, well, this month, they're likely not going to front run the tariffs. And you can tell that by the trade deficit dropping so much. So it is true that an $87 billion deficit, as opposed to 162 or whatever it was, will be a net positive. The reduction in inventories will be a net negative. So you can't sit there and say that just because we had a reduction in 4 means that GDP, this next print, is going to be just blowout. Now it could, but it all depends on these inventories. And I would assume that the inventories are going to be way lower than they were last month because the deficit went down to begin with. I just wanted to throw that in there. So you guys, because I know a lot of the rhetoric in the mainstream media and on social media is all about how last month's number really didn't matter as far as the GDP. And maybe it didn't. Maybe we'll see this blowout quarter, but it would have to be a result of inventories keeping up to the same level that they were when everyone was front running these tariffs. And I think that probability is pretty low. So now let's go over to markets and see how everything responded today to this lower than expected PCE. All right. So about flat, nothing too extreme. Now, Treasury yields down to 4.4%. And we've talked about this narrative that is just kind of bizarre to me, that everyone, like if you look at FinTwit, almost every single tweet is just, well, bonds are going up every day. Yields, well, this is crazy because yields are going up every day, or yields have exploded higher. No, they haven't. I mean, we did this yesterday, but here's a 1-year chart of the 10-year Treasury yield. Okay, we're flat. And sure, you had a big spike up here, during Liberation Day, or after that, I think it was April 9th. But then it came right back down. And then you have the big pause. So growth expectations increase. You have a big spike. Now you get softening data, goes back down. I mean, if you just ignored a chart and ignored the actual yield and just focused on social media, you would think that the 10-year Treasury yield is at like 57%. And it's going up by 5% every day or something. So just kind of bear that in mind when you're listening to the mainstream media or just scrolling through social media. Now, Bitcoin, this was really interesting to me because it broke through that resistance level, like 106. And, we got to like 111, 112. I thought it was off to the races, but I was not correct in that. And I'm not talking about long-term, I'm just talking about short-term trade there. So I got that one wrong for sure. And then gold down a bit today. I think the big one to watch is oil. We talked about this yesterday, down slightly today, but we're getting real close to, oil trading in the 50s, which I think is just a direct reflection of global demand. And that the downside here isn't really dramatic acceleration of inflation unless we get a huge supply shock, which we very well could see. But the bigger risk, I think, is kind of deflationary pressures from the global economy really, really slowing. Another thing that I'd like to point out in regards to the Fed is the 2-year Treasury yield. Let's check that out real quick. So, a similar story to the 10-year, but I think this is even more dramatic, where this is a 6-month chart of the 2-year. And like we were saying, if you listen to the mainstream media, if you listen to social media, you would think that the 2-year Treasury yield is just skyrocketing and just totally out of control. And every single day, it's just going higher and higher and higher. When you look at the chart, you're like, no, not really. In fact, today down at 3.91. And remember, Fed funds is still at 4.33. So I think the curve has been inverted for so long, people just forget that it's inverted and they don't pay any attention to it. The 2-year Treasury should not be trading under the overnight rate set by the Fed. That's that is not normal. That's not normal. That's not telling the Fed rates are too high. This is telling the Fed that rates are way, way, way too low. And every single time we have this knee-jerk reaction higher due to whatever, the trade, the tariffs are on, they're off, they're on, they're off, or we just get these, it's all noise, but you can see that the trend is definitely lower. And let's look at a 3-year chart. So we go back to 2023 and look at this. Go back to 2024. The trend is much, much lower from, call it, 2023 in the 2-year Treasury. And this is what you really got to pay attention to when trying to figure out what the Fed's next move is. The 2-year Treasury is telling you that it's got to be lower. And the 2-year Treasury is telling Jerome Powell that he's too high right now. I mean, the last thing the 2-year Treasury is telling you, or the 10-year, is that the market is worried about a reacceleration of inflation or stagflation. And I think the PCE today just backs that up. Okay, now, for those rebel capitalist fans out there, the OGs, the people that really are all about what rebel capitalist stands for, and that's freedom, liberty, and free market capitalism. I've got a surprise for you. We're going to switch up the screen share. I don't know where Josh went, but that's okay. We don't need Josh. Oh, there he is. So we're going to switch up the screen share. We're going to go over to, here we go. All right, Josh, so can you see this? Yeah, you can. All right. So what I wanted to do, because we've been talking a lot about AI, and it was really a hot topic at Rebel Capitalist Live, and I think that entrepreneurs, employees, I think we all have to really think this stuff through and determine how this is going to impact the overall economy. I think you got to start by, how does it impact your job? How does it impact your business? And then you have to keep going up and up and up till you get to that 30,000-foot level and say, how is this going to impact not just the US economy, but how is it going to impact the global economy? And then what are the central planners going to do in response? And this is, I've been talking about UBI lately and whatnot. But this is a website called Suno. And if you haven't checked this out, I'd strongly suggest doing so and playing around with it. It's a lot of fun. It's suno.com. And my editors, we had a meeting this morning about AI. So I suggested that they go over and check this out. And I think when you play around with this, you'll realize very, very quickly how this is going to impact so many industries and how it's going to impact jobs. And so one of my editors went and did this quick song, and she did a song on Rebel Capitalist. So the Rebel Capitalist song. So I wanted to share that with you guys really quick, and you can let me know in the chat or in the comments what you think. But the main reason I want to share this song with you is, number one, it's a song about being a rebel capitalist, which, come on, that's super cool. And number two is so you can listen to the song and then think about how this is going to impact the music business. And if it impacts the music business to this degree, how much is AI going to impact everything else? So hopefully this works here. We don't have Josh confirming that it does, but we've got the screen share selected, so I'm almost sure it's going to work. And again, how this was done, guys, is you just go to the website and then it has a prompt, and you just simply type in like a sentence or two. It like literally takes 2 seconds. You type in a sentence on what you want a song about, and then it has a couple keywords in there. Like this keyword was rock, electric, gritty, male vocals. Those were the keywords. And then you just hit create, and 10 seconds later, you've got a 3-minute and 19 or 3 minute 19-second song on whatever you want. And in this case, it's the Rebel Capitalist song. So here we go. And by the way, the lyrics are right here.
Designed. We break them down with calloused hands. Freedom screams across the lands. Rise up, rebels, don't you fall. Free minds answer to no call. Markets roaring wild and true. Power lies with me and you.
All right, now before we go any further, I want to make sure that you guys can hear me. Can you guys hear that? Yeah, it sounds like a Ford F-150 commercial. Yeah, it does, doesn't it? That's totally, you just pegged it. It's like a Nickelback song. And okay, here's Josh. You guys can hear that. So now let's listen to a couple more verses here. And again, guy, I want to restate, this is all AI. And this song was created by one of my editors this morning by simply typing in like a sentence or two and just hitting create. And 10 seconds later, out comes this. And I think what we can do is I can probably take the link and I'll put it in the chat for you guys. So I don't know that you have to set up an account, but you can probably just click on the link and listen to the song, tonight or whenever you want, if you like it. But let me know what you guys think of the song. Let's keep listening.
Paper kings with golden lies hide the truth in their disguise. We traded honor, not in chains. Rebel fire fuels our veins. Rise up, rebels, don't you fall. Free minds answer to no call. Markets roaring wild and true. Power lies with me and you.
There you go, guys. I won't play the whole song. You get the gist of it. And I'll put the link. In fact, let me do that right now. It's just before, so I don't forget. And hopefully you guys can listen to the song without setting up an account. But all you have to do to set up an account is it's just your email. Just give them a junk email or something like that. And then you can look at the lyrics and There we go. Okay, cool. So that's the link. And you guys can check it out at your convenience. You can play around with the website. You can do your own song. When we were at Rebel Capitalist Live, my good friend Robert Helms, who I've got the mastermind with Kenny and Hartman and Russ Gray, he did a song on his dog. And it was like this old fashioned like country song. It was really good. And you can, I mean, if you asked me if this was AI, I'd probably be able to tell you. But it's still a super cool song. And you got to realize that this is as bad as it's going to get. I mean, if it's this good now, just think about a year from now or 2 years. I mean, it's literally going to be where whatever you want to hear going to the gym, you can just go to your phone, you can type in a sentence on whatever type of song or whatever lyrics, whatever you want the song to be about, and you'll instantly have it. And you can just listen to a new song that you create every single day prior to going to the gym or doing whatever. I mean, it's really, it's terrifying, and it's super exciting, like at the exact same time. So, but the reason I'm sharing with this, again, twofold, guys. Number one, it's the Rebel Capitalist song. So come on. I mean, how cool is that? And number two, if this is where music is right now, think about how this is going to impact the music industry. And then think about how this is going to impact other industries in the US economy, in the global economy. And then think about what the government's response to that is going to be. I think it's all about the macro here. That's why, main reason I wanted to share it with you guys. All right. On that bombshell, enjoy your weekend. As always, make sure you're standing up for freedom, liberty, free market capitalism. And we'll see you on the next video.